Today, let's talk about two of the biggest tech titans in the world, Amazon and Google. These aren't just companies, they're household names that shape how we shop, search, and live every single day. Both are trillion-dollar businesses, both have huge global footprints, and both are constantly innovating. But here's the thing, when you dig into the numbers, the strategies, and the future outlook, one of them looks far more attractive as an investment right now. Let's break this down in a way that makes sense, without all the complicated financial jargon. Amazon and Google both dominate in their own fields. Amazon is the global leader in e-commerce and cloud computing, while Google is the king of search and digital advertising. Both companies are investing heavily in artificial intelligence. Both are building ecosystems that tie users in, and both have unmatched global reach. But here's where it gets interesting. Their business models overlap in some areas, like cloud services and advertising, yet they execute very differently. And that difference is why one looks like a much better bet for the next decade. Amazon isn't just an online store anymore. It's a collection of powerful businesses that feed into each other. Let's break it down. 1. E-commerce. Amazon's online marketplace is its backbone. What's fascinating is the shift from first-party sales, Amazon selling directly to customers, to third-party sales, independent sellers using Amazon's platform. Why does this matter? Because third-party sales are more profitable. Amazon collects fees, advertising revenue, and logistics charges without carrying all the risks of inventory. That's like running a mall, where you not only rent out space, but also take a cut of every sale. Experts say global e-commerce will grow between 15% and 19% annually in the coming years. Amazon's dominance in logistics, Prime membership, and brand trust gives it a huge edge. While Walmart, Target, and others are growing online, none have Amazon's scale. Over time, that shift to third-party sellers should fatten Amazon's profit margin significantly. 2. Subscriptions. This is where Prime comes in. Amazon Prime has hundreds of millions of members worldwide. Most of them already use it for free shipping, movies, music, and more. Growth has slowed a bit since so many people are already subscribed, but Amazon keeps finding ways to add value, like investing in Prime Video and even expanding into live sports. Think of it like Netflix, but bundled with free shipping, exclusive deals, and cloud perks. Even if subscription growth slows, it's a cash machine. 3. Advertising. Here's a part of Amazon's business most shoppers don't even realize exists. When you search for toothpaste on Amazon and see a sponsored brand at the top, that's ad money flowing straight to Amazon. What makes this different from Google Ads? Intent. If someone is already searching on Amazon, they're usually ready to buy. That makes Amazon ads far more powerful in driving actual sales. For brands, it's almost irresistible, and advertisers are noticing. Amazon has quietly built a multi-billion-dollar advertising empire, one that's growing faster than Google's. Think of it this way. Google is where you go to look for answers. Amazon is where you go to spend money. That difference is massive when it comes to ad revenue potential. 4. AWS. Amazon Web Services. If e-commerce and subscriptions are Amazon's bread and butter, AWS is the steak. It's the most profitable part of the business. AWS is the global leader in cloud computing, basically the backbone of the internet for businesses. When companies stream movies, run apps, or build AI models, chances are AWS is powering it behind the scenes. Even though growth has slowed a bit recently, AWS is expanding into AI chips like Trainium to reduce dependency on NVIDIA and position itself for the future of artificial intelligence. It's not just a cloud platform anymore, it's becoming a full AI infrastructure provider. Google, or Alphabet as the parent company is called, is best known for search. Its ads appear everywhere, on Google Search, YouTube, and across the web. For years, Google has been the toll booth of the internet. If you wanted traffic, you had to go through Google Ads. Google also runs YouTube, the second biggest search engine in the world. Add Gmail, Google Maps, Chrome, and Android, and you get a platform that billions of people use daily. This is why Google's ad business has been so dominant. Then there's Google Cloud. While smaller than AWS and Microsoft Azure, Google Cloud has been growing rapidly, especially with AI services. Thanks to DeepMind and Gemini, Google is positioning itself as the go-to cloud provider for machine learning and advanced AI tools. But here's the challenge. Ads are still Google's bread and butter, making up the majority of revenue and profits. And with TikTok, AI chatbots, and privacy changes affecting ad targeting, Google faces stronger headwinds than Amazon does in ads. Google dominates ads in terms of scale, but Amazon is catching up fast with a very different kind of advantage. Google captures attention, Amazon captures intent. If you're a company selling shampoo, where would you rather spend your marketing dollars? On a YouTube ad people might skip, or on a sponsored listing that pops up right as someone is adding shampoo to their cart? That's the power of Amazon. Analysts expect digital ads to grow about 14 to 15% annually in the coming years. While Google will continue to lead, Amazon is carving out a growing slice of the pie that is much more profitable per click. AWS is the undisputed leader in cloud services. It's the default choice for many businesses, with unmatched global reach and reliability. Google Cloud, on the other hand, has carved out a niche in AI and data analytics. Companies that want advanced machine learning often choose Google Cloud. The cloud market is expected to grow more than 20% annually over the next several years. AWS has scale and profitability on its side, with margins above 30%. Google Cloud is growing quickly and has turned profitable, but it still lags AWS in both size and consistency. The battle here is fierce, but Amazon still has the upper hand. Here's where things get really telling. Based on discounted cash flow models and different growth scenarios, I estimate Amazon's fair value could range between $2.3 trillion and $4.6 trillion. In the worst case scenario, Amazon looks only slightly overvalued by about 6%. But in the best case scenario, it could be undervalued by nearly 90%. For Google, the range is between $1.9 trillion and $4.4 trillion. In the worst case, Google could be overvalued by more than 30%. In the best case, it's undervalued by about 48%. That means Google is trading closer to fair value, while Amazon has far more upside. Think about it like this. Amazon is becoming part of people's daily lives in ways that keep expanding. From shopping to streaming to running the internet itself, Amazon has its hands in everything. And every new service, ads, subscriptions, logistics feeds into the larger machine. Google, meanwhile, is still incredibly powerful. Billions use it every day, but most of its money still comes from ads. And that makes it more vulnerable to disruption. Yes, Google Cloud is growing, and yes, AI is exciting, but Amazon's growth engines are more diversified and more insulated against big shifts. Conclusion. Both Amazon and Google are giants. Both are innovative. Both will play massive roles in shaping the next decade of technology. But if you're looking at the numbers, the risks, and the potential rewards, Amazon comes out on top. Even in the most conservative case, investors aren't overpaying much for Amazon stock, and the upside is enormous. With advertising, AWS, and e-commerce all firing together, Amazon looks like the stronger long-term bet. Google isn't a sell, it's still a powerhouse. But in terms of opportunity, Amazon is the one that looks severely undervalued today. So if I had to choose where to put my money right now between Amazon and Google, I'd choose Amazon every time. And that's not just looking at the next quarter, that's looking at the next decade.